Welcome everyone to the most exhilarating, most transformative journey you are about to witness. The 30-day trading challenge, a deep dive, a complete immersion into the relentless world of financial markets. I am here, you are here, and together we are embarking on an epic quest to conquer the trading arena, to unlock consistent profits, and to forge a winning mindset. This is not just another video, this is a declaration, a commitment, to elevate our financial destinies. We are going to dissect every nuance, every strategy, every psychological hurdle that traders face every single day. Forget the get-rich-quick schemes. Dismiss the magic formulas, because true success in trading comes from discipline, from relentless learning, and from an unwavering dedication to improvement. For the next 30 days, we are building from the ground up. A robust trading framework, a system that is designed for longevity, for consistency, not for fleeting wins. We will explore the core principles of market dynamics, of price action, of risk management, and perhaps most importantly of self-mastery. This challenge is for you, whether you are a seasoned veteran looking to refine your edge, or a complete beginner eager to step into this fascinating world. We are going to demystify the complex jargon, simplify the intricate concepts, and present them in a way that is actionable, understandable, and immediately applicable. Think of this as your personal boot camp, your intensive training program for financial independence. We will be covering everything from setting up your trading environment, to executing your first trades, to managing your emotional responses under pressure. We are talking about real charts, real market conditions, and real-time decision-making. The goal is not just to survive the 30 days. It is to emerge from this challenge with a profound understanding of how markets work, of how you work within those markets, and with a tangible blueprint for future success. So buckle up, tighten your seatbelts, because the journey begins right now. This is more than a challenge. It is a transformation waiting to happen. Are you ready to embrace the grind, to push your limits, and to redefine what is possible in your trading journey in the next 30 days right here, right now with us? Before we even touch a single chart, before we analyze a single stock, we must address the most critical component of trading success, the mindset. Trading is 80% psychology, 20% strategy. Without the right mental framework, even the most brilliant strategy will crumble under pressure. So what exactly constitutes a winning trader's mindset? What are the pillars that support sustained profitability? Firstly, it is about embracing uncertainty, not fearing it. Markets are inherently unpredictable. They move with their own rhythm, their own logic, and often with no apparent logic at all. A successful trader understands this, accepts this, and thrives within this volatility, seeing opportunities where others see chaos. Secondly, emotional control is paramount, absolutely essential. Fear and greed are the twin demons of trading. Fear can paralyze you from taking profitable trades, or force you to exit winning positions too early. Greed can push you into overtrading, into taking excessive risks, into holding on to losing trades for too long. We need to cultivate a detached perspective, to view every trade objectively, as a probability, not as a certainty. This means developing the discipline to follow your trading plan rigorously, without emotional interference. It means having the courage to cut losses quickly, and the patience to let winners run to their full potential. Thirdly, resilience is non-negotiable. You will experience losses. That is a guarantee. There will be drawdowns. There will be losing streaks. Even for the best traders, what separates the successful from the unsuccessful is their ability to bounce back from these setbacks, to learn from their mistakes, and to keep going. Every loss is a lesson. Every mistake is an opportunity for growth. It is about maintaining a positive, yet realistic outlook. Understanding that consistent profitability is a marathon, not a sprint. It is about focusing on the process, not just the outcome, about continuous improvement. Finally, self-awareness is key. Understanding your strengths, your weaknesses, your biases, your typical emotional responses to market movements is crucial. Are you prone to revenge trading after a loss? Do you get easily excited by big winning streaks? Do you hesitate when the market moves against you? Recognizing these patterns allows you to create safeguards to mitigate their negative impact. Journaling your trades, reflecting on your performance, both good and bad, becomes an invaluable tool for self-improvement. The mind is your most powerful asset in trading. Train it, nurture it, and it will serve you well. Without this foundation, any strategy, however perfect. Now that we have laid the psychological groundwork, it is time to talk about the physical and practical aspects of setting up your trading environment. A well-organized, efficient, and distraction-free workspace is fundamental for focused trading. This is not just about aesthetics. It is about optimizing your decision-making process and minimizing potential errors. Firstly, your hardware, a reliable computer, is non-negotiable. You need sufficient processing power, enough RAM, and a stable internet connection to handle real-time data. Without lag, multiple monitors, while not strictly necessary, are highly recommended. They allow you to view multiple charts, different time frames, and your order book simultaneously, enhancing your situational awareness. Secondly, your software. Choosing the right trading platform is crucial. Popular platforms include Thinkorswim, Interactive Brokers, E-Trade, and others. Research these options. Understand their features, their fees, their charting capabilities, and their order execution types. Many brokers offer demo accounts, a fantastic resource for practicing without risking real capital. Utilize these to familiarize yourself with the platform's interface, to test out your strategies in a simulated environment before going live. Your charting software is equally important. Look for platforms that offer a wide range of indicators, drawing tools, and customizable layouts to suit your analytical needs. Thirdly, data feeds. Ensure you have access to real-time market data. Delayed data is useless for active trading, especially for strategies like scalping or day trading where every second counts. Most reputable brokers provide real-time data, often for a small fee or sometimes free. If you meet certain trading volume requirements, understand the difference between Level 1 and Level 2 data. Level 1 shows the best bid and ask. Level 2 shows the full order book depth, which can be invaluable for understanding supply and demand at different price levels. Finally, eliminate distractions. Your trading desk should be a sanctuary for focus. Turn off social media notifications. Put your phone on silent. Inform family members or housemates that you need uninterrupted time. A clean, organized desk contributes to a clear, organized mind. Have everything you need within reach: your trading journal, a notepad, a pen. Consider investing in a comfortable chair, since you will be spending significant time at your desk. This preparation, this meticulous setup, is not overkill. It is a critical step in giving yourself the best possible chance for success. Your environment reflects your approach to trading. Make it professional. Make it conducive to high performance. Now let us dive into the heart of the markets, understanding how prices actually move. This is not just about looking at green and red candles. It is about grasping the underlying forces of supply and demand that drive every single price fluctuation. At its simplest, price moves up when demand exceeds supply. More buyers than sellers. Price moves down when supply exceeds demand. More sellers than buyers. This fundamental principle underpins all market behavior, from a microsecond tick to a multi-year trend. Firstly, let us talk about order types. These are the instructions you give to your broker for executing your trades. A market order is an instruction to buy or sell immediately at the best available price. While fast, it offers no price guarantee, meaning you might get filled at a price slightly different than what you saw on your screen. Especially in fast-moving or illiquid markets, a limit order is an instruction to buy or sell at a specific price or better. If you place a buy limit order at $10, it will only execute if the price drops to $10 or lower. If you place a sell limit order at $10, It will only execute if the price rises to $10 or higher. Limit orders give you price control, but no execution guarantee. They might not get filled if the market does not reach your specified price. Next, we have stop-loss orders. This is perhaps the single most important risk management tool for any trader. A stop-loss order is designed to limit your potential loss on a trade. If you buy a stock at $100 and place a stop-loss at $98, your shares will automatically be sold if the price drops to $98. This prevents a small loss from turning into a catastrophic one. A take-profit order, also known as a limit order for selling at a profit, allows you to lock in gains once your target price is reached. If you buy a stock at $100 and set a take profit at $105, your shares will be sold at $105, securing your profit. Then there is the concept of bid-ask spread. This is the difference between the highest price a buyer is willing to pay, the bid, and the lowest price a seller is willing to accept, the ask. When you buy using a market order, you generally buy at the ask price. When you sell using a market order, you generally sell at the bid price. The wider the spread, the more costly it is to enter and exit a trade. High volume, liquid stocks usually have very tight spreads, making them more efficient to trade. Finally, we need to understand different market phases. Markets don't just go up or down in a straight line, they move in trends, uptrends, downtrends, and sideways or consolidation phases. An uptrend is characterized by higher highs and higher lows, a downtrend by lower highs and lower lows. A sideways market or range is where price oscillates between a defined support and resistance level. Identifying these phases is crucial for applying the appropriate strategies. Trend-following strategies work well in trending markets, while range-bound strategies are suitable for consolidation. Understanding these mechanics, the interplay of orders, liquidity, and market structure, gives you the fundamental knowledge to interpret price action and make informed trading decisions. Charts are the language of the market. They are visual representations of price action over time. Learning to read them is like learning a new language, essential for effective communication with the market. While there are many types of charts, candlestick charts are by far the most popular, and for good reason. They provide a wealth of information in a compact and easily digestible format. Each candlestick represents a specific time period, whether it is 1 minute, 5 minutes, 1 hour, 1 day, or 1 week. A candlestick has a body and 2 wicks, or shadows. The body represents the opening and closing prices. If the closing price is higher than the opening price, the candle is typically green or white, indicating a bullish move. If the closing price is lower than the opening price, the candle is typically red or black, indicating a bearish move. The wicks or shadows represent the highest and lowest prices reached during that period. The top of the upper wick is the high, and the bottom of the lower wick is the low. Understanding these basic components allows us to interpret what happened during that specific time frame. A long green body with small wicks indicates strong buying pressure, where buyers dominated the entire period. A long red body with small wicks indicates strong selling pressure, where sellers were in control. A small body with long wicks, like a doji, suggests indecision in the market, where buyers and sellers were evenly matched. Beyond individual candles, we look for candlestick patterns, which can signal potential reversals or continuation of trends. Examples include the engulfing pattern, where a large candle completely engulfs the previous candle, signaling a strong shift in momentum. A hammer or an inverted hammer, often appearing at the bottom of a downtrend, can signal a potential reversal to the upside. A shooting star or a hanging man, at the top of an uptrend, can signal a potential reversal to the downside. These patterns are not infallible, but they provide valuable clues about market sentiment. Furthermore, we use support and resistance levels. A support level is a price point where buying interest is strong enough to stop or reverse a downtrend. Think of it as a floor. A resistance level is a price point where selling interest is strong enough to stop or reverse an uptrend. Think of it as a ceiling. These levels are often identified by previous price action, where the market has bounced or reversed multiple times. When support is broken, it can often become new resistance, and vice versa. Drawing these lines on your charts helps you identify potential entry and exit points for your trades. Mastering chart reading is a continuous process, but these basics provide a solid foundation for interpreting the story the market is telling you. While pure price action and candlestick patterns provide a powerful foundation, technical indicators can act as supplementary tools to confirm your analysis and provide additional insights into market dynamics. Think of them as different lenses through which to view the same market data. It is crucial not to rely solely on indicators, but to use them in conjunction with price action for a more comprehensive understanding. One of the most common and widely used indicators is the moving average, MA. A moving average smooths out price data over a specified period to create a single flowing line. There are simple moving averages, SMA, and exponential moving averages, EMA. EMAs give more weight to recent prices, making them more responsive to current market movements. Moving averages are used to identify trends and potential support or resistance levels. When price is above a moving average, it suggests an uptrend. Below it, a downtrend. Crossovers of different moving averages, e.g., a 50-period MA crossing above a 200-period MA, often referred to as a golden cross,